So I'm supposed to talk about volatility today. So I'm going to start with who can tell me what was the least volatile year ever in the stock market, where it went up every month of the year, the only time that's ever happened. Anybody have a guess? The good old days of 2017. That's right, just yesterday, it seems. And then came 2018. Now, only 4 weeks in, we were up 7.5%. 2 weeks later, we're down 10%. A month later, we're up to 8%. Over the next 3 weeks, we're down 7%. Then, spring blossomed, summer warmed us with a 14.5% return, and then fall came, and the fall came. Down almost 20% in the 2 months right before Christmas. But Santa Claus was good to us. It's up, I think, 12% since Christmas. So since the beginning of last year until right this minute, this very minute, the stock market's return with dividends is 2/3 of 1%. Now, sure, you could have gotten that in any one of the banks that are represented here today, but think of the joyride you would have missed just sitting in that bank. Now, for this year, the economy's still strong. It is slowing down. It's hard to tell how much since all the people who do that counting are on furlough right now, but growth will be less. We don't know how much. It won't be bad, it's just not as good. And will we have a recession? I give it a 50-50 chance. And the market this year will again be led by that raucous band, Big E and the 4 T's. The Big E is earnings, the growth in corporate earnings, which is why we buy stocks. And the 4 T's are tariffs, tightening by the Federal Reserve, higher interest rates, too much debt. Did you know that student debt is now triple credit card debt in our country? And the last one is Twitter. And I don't mean the company. And in these days of instantaneous reactions to news, volatility will still ride high, so get used to it. So what can you do to navigate this kind of volatility, which incidentally is the norm, not the exception? 2017 was the exception. Now, surely there's an algorithm or some stunning intuition or some inside information that can tell us when to get out at the bottom and when to get back in, get out at the top. Yeah, that's the way we do it at Wacker Wealth, by gosh. Get out at the top and then get back in at the bottom. And we all have anecdotal evidence this is possible because our neighbor went to cash at just the right time. Our brother-in-law's broker got him out of the market. That ad on the internet said they could do it. So we know it must be possible. But as seductive as that sounds, the empirical evidence is very, very clear. It's almost impossible to make those two timing decisions to make that work. Getting out at the right time and getting in at the right time. Even if you are close to getting out, when it's at the bottom, it looks just awful. That's why it's the bottom. And when it's the bottom, it's hard to dive into a pool that's filled with green scum. And that's what you're trying to do. But maybe you could add commodities or gold to your portfolio. Of course, over the last 10 years, you would have made a lot less money. Maybe cryptocurrencies, because they're not very volatile. Bitcoin was only down 75% last year. You can invest in long short funds or tactical allocation funds and move between stocks and bonds. They all have certain things in common. They are less volatile, they are hideously expensive, and they will make somewhere between 40% to 70% of the stock market return over the long term. Just about what a balanced portfolio of stocks and bonds would do, but not nearly as much time. But if you're an investor, not a trader or a speculator, with an investment horizon past next week or next year, then you need to have a personal investment policy. You need to have it preferably written, and that should target a stock allocation that is going to be in a volatile and down stock market, will not breach your economic tolerance for risk, your risk capacity, that's what you can afford to lose, and your emotional tolerance for risk, that's what your gut can take. So a well-reasoned policy, though, when the big drop comes, it's not going to scare you into bailing out of your plan. And that policy may change as you age, but it shouldn't change depending on what you think will happen next, because you don't know. Nobody knows. But most investors are their own worst enemy. They either let fear or overconfidence or political beliefs lead them to feel that they have to do something when what they should do is what you're doing right now. Sit there. So focus on what you can control. That's you and not the markets. Design and stick with an appropriate plan. Stop checking that stocks app on your phone. And for crying out loud, stop watching Fast Money and Mad Money on CNBC. So be smart, hang in there, and happy investing. Thank you.